Symposia?
Yes, I think we're scheduled. I don't think we have the exact date lined up just yet. We'll be taking a break from Symposia for the months of December, January, and February, and then we'll be picking things back up in March. And we'll have our next session in March after everybody hopefully gets their able to pick their head up from closing out the year and year-end close and all of those things. And I think, Jim, did I see, I think I see Jim Parent join. Jim, are you there? Well, I thought I saw him join. I can see a list of the participants and it looked like him. Maybe it wasn't.
Adam, if we want to get started with John and you and I, we can kind of walk through this a little bit here, and then hopefully Jim will be jumping in here any minute now. We've reached out to him in a number of ways we could. So.
Yeah, no, hey, Tony, I'm on the call.
Oh, perfect.
Oh, hey, Jim.
Hey, it started at 1 o'clock, right?
Yes.
We had, yeah, I think we may have had the meeting invite scheduled for a few minutes ahead of time. So.
Okay, no problem.
We're all here and ready to go. So I will go ahead and start with a brief introduction. So our presenters today are going to be John Briscoe and Jim Parent. Jim Parent is the current head of tax at Nestle USA. He started there in April of this year. Prior to that, he was the head of tax, vice president of tax at Weatherford International, where I'm sure Jim and John will be able to share many stories from their time at Weatherford together. But Jim was basically brought in to help the company remediate several material weaknesses and financial restatements. And he started there in 2012 until he left to join Nestle earlier this year. Prior to that, Jim was the vice president of tax reporting for Tyco International for 6 years. And he started his career in '93 with PricewaterhouseCoopers and moved up the firm and left as a director of the Consumer Industrial Products Group. His background is he has a undergrad degree in accounting, master's in tax, as well as a law degree. And with Jim, we'll be presenting with John Briscoe. John has over 35 years of experience in the finance and energy industry, providing consulting and advisory services to public and private energy companies and to public and private energy investors since his retirement in 2015. Most recently, he served as the vice president and chief financial officer for Bristow Group from 2014 until his retirement. He joined Weatherford International in 2011 as the chief accounting officer and served as chief financial officer for 2012 and 2013. And during that time is when he actually hired Jim to run the tax department. Prior to that, from 2005 to 2011, he served various roles at Transocean, including finance director for the Americas, director of investor relations, VP of internal audit, and vice president controller for the last 3 years. And then he had several other accounting and CFO roles prior to that. So with that, I'm going to turn things over to you, Jim and John, and let you guys take it away.
Thank you, Adam. John, would you like to start, or would you like me to start?
Go ahead, Jim. Go ahead and jump in.
Perfect. So I guess I'm not sure exactly who is on the call. I did see the list of participants, and so there were at least 3 people who probably know me relatively well. And so I guess if I say anything that's inconsistent or wrong, you guys should call me out for it. We definitely hope this is more of a proactive or interactive session, and that, it's more of a dialogue than it is us trying to present to you, us being John and I. We appreciate Tony, giving us this opportunity to kind of, address these topics and talk with y'all, partly from the perspective that, industry relationships are important, and hopefully if we can provide some insight, it's helpful. And then, even if we don't do it on this call, feel free to get our information from Tony and reach out to us individually if there's any way, we can clarify any points that we make or expand upon them as needed. Our understanding is, this is the third of multiple sessions, and that, the success factors that they want us to touch upon, are, as noted here. I don't have slide numbers, but on the critical success factors. And so, these are the topics that we hope to address and address effectively. We do have a list of questions, and so I guess, Tony and team, I would just ask you guys to let us know if you just want us to start interjecting with the questions or go through the slides, because we'll obviously be very flexible in how you guys want us to address it. The topics we're going to cover is obviously ongoing alignment on company objectives and culture, and the importance of that, understanding company risk tolerance, business case for each project, delivery on expectations, collaboration, communication, and then, how do you provide strategic and operational leadership within your budget? So starting on the first slide, I guess, alignment on company objectives. The one thing I have always experienced is the fact that the tax department will have some of its own objectives due to the special nature of tax, and there's a lot that we do that affects the business or is directly related to the business, and there's a lot that we can influence by being tax professionals and very knowledgeable about things the company can do, not directly related to operations, to help lower the overall tax position of the company. In tax, as I've started to learn a lot more as my career has gone on, it's not just income tax, it's sales and use tax, it's property tax, it's withholding tax. If it's got tax in the name, at some point in time, they're going to come to you and say, hey, why aren't we addressing the following issue, or is there something we could be doing better? The other thing, I guess, that, it's become very clear to me is, the board cares about the business. The board doesn't really always focus specifically on tax. And so, when you look at what their objectives are versus what the CEO is focused on, and even what the CFO is focused on, which a lot of times is areas other than what we think about day to day, the question is, how do our objectives align with the company's overall objectives? And I guess what I would say is they do, because at the end of the day, shareholders really care about earnings per share, and the biggest line that matters in getting to earnings per share is usually tax, unless you're in a loss position and you're not getting any benefit for your NOLs. But as a general matter, it's the biggest line. And so being able to educate those around you, which includes the CEO, CFO, as to what they're doing, how it affects the bottom line tax number, or could affect the bottom line tax number, is always very important. And I guess, one question is just, how do you do that? One way I've always done it is tried to send the CFO small emails identifying issues that may be of relevance to him, that may affect things that he's working on, that we should be talking about at a later point in time. And I've always tried to send multiple of those emails from the perspective of, if you hear something once when you got a lot going on, you completely ignore it. If you hear it twice, it starts to at least become a recollection to you. Yeah, someone said this to me before. When you hear it a third time, you actually start to remember it. And so, I mean, I did some math last night, and I think I've worked for 6 different CFOs. And for all of them, I've always tried to send them quick emails, giving them an FYI on topics to help to start to educate them to then, be discussion points that then drive to something the business is trying to achieve, or should be thinking about, to then allow it to come back, as something more meaningful to them when you start to bring them tax ideas. So, that is one potential way to ensure that your objectives in the tax area are understood by others in the company and are recognized, are recognized. Let me pause there.
John, if I can jump in real quick and just, reinforce some of what you're saying. Because I absolutely remember receiving some of your emails that were talking about either a particular issue, maybe it was a particular project you were working on, maybe it was something that was brought up by an outside advisor. And I can't tell you how many times, because I really can't remember how many times, but it was more than a few times that I would be in a meeting, maybe it was a board meeting, maybe it was a senior management meeting, and a subject would come up, and this little, bell would ding in the back of my brain saying, Jim sent you a note about this. I would pull it up, and then I was able to be relevant on a topic that I was not an expert on, because I'm not a tax expert. My experience is not in tax. But that approach was very effective. It was very effective for me in making me more effective, but it was also a very effective way to, I'll call it, communicate, without having, a long meeting on everything going on, give me an opportunity to be aware of what's going on. And if there was something where we need to sit down and spend more time, I'd make a note, next time we get together, we would spend some real time on that particular topic. So I think this is an excellent takeaway. And the only other comment I'll make about the board not caring about tax, the only time the board cares about tax is when there's a tax problem. And then the board is all over tax. And Jim, I'm sure you've seen this before. And so some of this gets back to what we're going to talk about later in being proactive around communication, because being proactive around communication, working with other parts of the organization, I think is the best way you help prevent problems or issues in tax that then the board gets interested in.
Well, I'm glad to hear, John, that they were helpful to you. What I can say anecdotally is most of the other CFOs have said the exact same thing. And yeah, I can't tell you how important it is when you are sitting in a meeting and something is coming up, and you know for a fact the CFO is informed. It does make you feel a little bit better that you've been a little bit proactive and that you've made your boss look good. Because at the end of the day, part of our jobs is always to try and make our boss look good, and that then helps the finance organization when you really think about it. And if the finance organization is viewed in a positive light, it makes things easier. There was a question that said, since I've only been in one industry my entire career, I'm curious if the performance metrics vary from one industry to another. I think it's fair to say I've been in at least 2 industries, maybe 3 industries, and I'm not sure the performance metrics really change by industry. It probably changes more by the status of the company, i.e., is it very, very profitable, or is it significantly operating at a loss? Because the focus of management becomes just a little different. If you're a very profitable company, then there's less of a focus on cash taxes, and there's more of a focus on your income tax. So, it's been my experience, right, that it's not really industry specific as much as it's the nature of which, or the environment that the company finds itself. There are 3 areas that I think are critical to always be focused on from a tax perspective. 1 is the income tax. 2 is cash taxes. And a lot of folks don't think about cash taxes if they're in a very profitable industry. But the more I've interacted with different companies, the more I've realized cash taxes really are just as important. And if you educate the CFO as to the importance of cash taxes and how you're influencing it, you can get a lot of credit. And then the operational, the taxes that hit the operations. So property tax, sales and use tax, state tax, although that's income tax. But if you focus on the areas that helps the earnings before tax, I've been finding that there's a lot of focus in that area too. And that's where there was a question around, how do you, kind of build relationships with other organizations within the company. If you're doing something that actually benefits them, it's something that's very meaningful to them, then they're going to want to bring you into the fold, more often, earlier, et cetera, because you're actually going to help them drive their bottom line. And so there's a lot we do in tax that helps all of the other organizations. And what I would say is the more you can interact with the other organizations on a day-to-day basis, it probably is going to help you build relationships and then help you be more effective as the leader of the tax organization. So I'll pause there before I move.
Reiterate that if I can, because you really can't overstate the importance of tax having, I'll call it a relationship with the business units. I mean, you have to interact with the rest of finance. I think that's a given. But if you really want to, I'll call it, get a seat at the table, then start interacting with the businesses and start showing them how you can benefit their business by being a partner, with the business units, and then you'll really begin to see that tax will not just play a bigger role, but will have more impact on the organization.
So are there any questions before we move to understanding the company risk tolerance? So moving to this slide, what I will say is, I don't know about all of you, but for myself, I can honestly say that I continue to grow and learn every single day. You learn from your peers around you. You learn from people that work for you. You learn from people that you work for. When it comes to understanding a company's risk tolerance, I will say that every company is different. And, here is one where there's a project, I won't name the company, so there's three you could guess from. There's a project that we were proposing, and much to my surprise, what seemed to be very black and white ended up being evaluated by a local management team, a global management team, a global executive board, and a board of directors of the overall company for what it was a simple restructuring. And it really came down to the risk management that the company had and the risk tolerance that they had, and wanting to make sure that everybody was aligned in what was happening. What I would say is the really good thing was when this project was proposed, all of the risks were very clearly laid out. Risks and opportunities were very, very clearly laid out. And they never wavered, meaning what we communicated and the level of specificity we communicated, which was very robust, through all those levels of review, answered all the questions. And so it ultimately worked out just fine. But, for some companies, you can do a transaction and you're getting the CFO to kind of sign off and you move forward. For other companies, there's a lot more people involved. My experience is the more people you get involved, you communicate with, you explain what you're doing and why you're doing it, the better off you are. Because as more people understand what's going on or learn what's going on, you take noise out of the system. And, understanding, company risk tolerance, one comment I would have is I have 2 or 3 very, very strong advisors, very capable advisors that no matter who I'm working with, I'll always go back to them to bounce the ideas off of. And having a couple of people like that are really critical, because what you want from your advisors is you want people who are going to give you the correct answer, not the answer you want to hear. And you don't always get the correct answer. Well, you always get a correct answer, but you don't always get a fulsome answer if people are trying to give you what you want to hear. And so having a strong advisor is important. And then this do no harm comment on the page, I have always communicated to my bosses that there's 2 types of planning projects. There's one that's we're going to have to do because the business is doing something. And so if the business comes to you and says, we are transferring the following IP, to this country because this is where we want to run the business from, et cetera, or whatever they tell you they're going to do, if it's business related, I don't get real excited about what's the potential tax implications of doing it. I'm trying to mitigate that tax implication to the best extent possible. And if I only do it to a more likely than not basis, so be it. It is what it is. The business wanted to do it. We're going to have to pay the taxes that are due. We'll mitigate it to the extent we can. And if we're only at more likely than not, I've done no harm. If we do restructuring because we think there's a better way to have the company structured from a tax point of view, but it doesn't perfectly align with the business objectives, then if you do it at more likely than not and it blows up, you've done harm to the company because there was risk inherent in what you did that really had no, I want to be careful, right? We all understand there's business purpose and there's business purpose. But, from my perspective, if I'm ever doing something that isn't being pulled by the business, we definitely are a lot more risk averse than if it's driven by a M&A transaction or a business transaction. Hopefully that makes sense. And when it does come to talk about risk, as I said earlier, speaking with clarity on the front end is absolutely critical, because you have to assume between your management pushing on the issues, your auditors auditing the issues, and then talking to management with you in the room and without you in the room, with other advisors potentially weighing in on it, depending upon who's impacted. If you don't speak with clarity on risk, it's going to be pretty detrimental or problematic. One of the questions that came up was, how do you handle situations in which the end result for a project you have previewed for management does not materialize? If you've clearly articulated the risks, then hopefully there may not have been the benefit you hoped could be achieved. However, you've articulated the fact that there may not be benefit, and here's the reason why, but we still think it's prudent to move forward. And so when the benefit doesn't materialize, the hope would be you've given them that as a possibility and the reason why. And while you did a bunch of work and didn't get the benefit, you at least communicated it. So let me pause there for a minute.
I think that's a very important point, to make sure that you're communicating the risk, but also make sure that you're communicating, I'll call it kind of, risk-weighted benefits. So, what is your benefit? What's the risk associated with the benefit at the maximum level? What's the risk and what's the benefit associated with the minimum level, so that the decision maker is able to see, what the range of benefits are as well as what the range of risks are. So, it'll be, more likely to take something that, may have a little bit higher risk if the downside, from a dollar point of view, just isn't that great, so that, I'm seeing it as, there's more upside where okay, there's, maybe a benefit here, but the downside of a different, project may be much greater than I may be more risk averse in that situation. So, not just, risk in terms of success, but also risk in terms of, dollars, quantifying the benefits, or maybe it's a exposure that's being mitigated, and what is the dollar amount of exposure being mitigated.
Exactly.
Jim, this is Adam. Hey, Jim, this is Adam. I know when we were doing our pre-meeting or pre-session planning, you mentioned if a planning idea comes about because the business is going to do something anyways, didn't you say you tend to be more, you tend to assume a little more risk because the business was going to do something anyways, and tax was kind of coming along versus if you're bringing the idea to the table?
Absolutely. Agree. Yep.
Yeah.
And I would also say if the business is doing something and there is a risk that you think they may not be aware of, then don't be afraid to speak up and say, understand this is direction that we're going, but we're also adding on a risk of X or risk of Y. I'm not saying, don't be negative, because again, this is a business decision, but make sure that the decision makers have all the information so that they understand those risks, even though it may be a direction they're going anyway.
Yeah, and the one thing I would say is it's always very helpful to try and think outside the box or think ahead and figure out what's going to actually cause you a problem, and try to be proactive to either A, address the problem, or B, communicate it very clearly that problem could be there. Because look, whenever you start moving pieces around a checkerboard or chessboard, or quite frankly an org chart, unintended consequences can present themselves, and it just takes a lot of effort to really go through all of the potential outcomes and just make sure that you've tried to cover off on them, which in the end you will still have one or two unintended outcomes, but hopefully you don't have anything that's materially problematic, and then you just have to deal with them. If we move to the next section, business case for each project, I guess there's a lot, potentially on the slide, and we've covered a bit of it. I think we've covered a bit of it already. Maybe the biggest item on here to cover is our objectives achievable. I will be honest, right? And anybody who's worked in my department will probably attest to this. I mean, I have a tendency to probably try to overcommit to meeting objectives. And then when it comes to overcommitting, also then not having a lot of sensitivity or tolerance to, well, okay, we can't achieve it because this department can't do what they need to do, or we can't achieve it because we've got this obstacle there. I mean, my view has always been, we control our own destiny. We should be able to influence the other departments and the other groups and be able to still get the outcomes that we've committed to or set out to achieve. What I will say is, for the most part, I think when you do look back over a period of time, if you have that approach, you end up achieving a lot more than most people would think is possible. The question then just becomes, what is that impact on the environment of the department? And, are you fairly compensating people for that, for that level of effort? And so if you're fairly compensating people for that level of effort, they're being recognized within the organization, it's probably a good mix. If that doesn't happen, well, then I think you got to scale it back and be cognizant of and respectful of what the organization is looking for and is asking for from its individuals, or from its departments and from its tax department. What I would say is, I constantly have discussions with my CFOs around what is it they want us to achieve, what is it we could potentially achieve, what is what is the cost and the benefit, and let them help us make the decisions. And I think for the most part, in the end, you get recognized as a leader and the department gets recognized for its contributions if you do set more aggressive goals than, I guess, easy goals. And, I guess you gotta figure out, do you have a team that's looking for the more aggressive achievements or not? And then what type of team do you want in your department? I mean, what I will say is, I've been at Nestle for April 23rd is when I started. So, it's been, less than 9 months. And on a call probably about 2 weeks ago, the CFO did say, well, Jim, you've done X, Y, Z, and W. I mean, there was a lot X, Y. Well, let's not get into my alphabetical order, but you've done all of this. What are you going to do next year? And the reality is, when I got here, determined what needed to get done, and we set out the objectives for what we were going to achieve, it was based on, one, what are the resources I had available? And quite frankly, we have a very large department. Two, what are the benefits we can drive for the organization? And quite frankly, there were a lot of benefits to be driven for the organization. And three, did we have the capabilities and the resources to make it happen? And we were able to have a business case for the major projects to have them be pushed forward. And so I have no idea what we're going to do for 19, because I've told everyone I've come here for work-life balance. And so, I don't need to have all these projects going on. But in the end, if there is a business case and there's substantive things to be achieved, my approach has always been to try and find the resources, whether you have to outsource it or whether you can kind of push your folks just a little bit harder. My approach has always been to do it, obviously balancing the needs of our employees and our people with, what the company hopes to achieve. And these were projects to get done at the same time. In the news, we were acquiring Starbucks, a component of Starbucks, retail business. At the same time, we're doing a strategic review of our skin health business, et cetera. So, I guess, just from my perspective, I've always pushed a little bit harder than a little bit less. I'll pause there. I don't know, John, if you have anything to add there, or Adam.
Yeah, dude. Just a couple of points. One around a business case for each project. From my point of view of the CFO, each project should have a return on investment. And okay, it may be that you can't go through an exact, ROI calculation. That's not what I'm saying is required. But you're either going to be committing outside advisor dollars toward a project, or you're going to be committing internal resources to a project that then may not be available for other projects. So, I just assume that you've always got a list of projects that you want to go through, and you never, totally empty that bucket of projects that you'd like to complete. So there's trade-offs. You have to look at what is the return on investment of one project versus another. And it may be that it's driving your EPS, and so that's part of the return. It may be that it's driving your cash taxes. That's part of the return. But from a CFO point of view, that's what I always want to see when it comes to projects. Talking about goals, I agree with not setting unrealistic goals, but I do think you should set aspirational goals. So goals that help drive the organization further, and not just going, okay, well, we're just going to go this far. Well, why can't we go a little bit farther? Let's strive to go farther. I'm not saying that, there's a fine line between being aspirational and a sweatshop, but I think that aspirational goals are things that people can latch onto and then get a lot of satisfaction from as well. And the other thing is, always remember when you have projects, that's an opportunity to develop your staff. So you've got a new project, it's, in a challenging area. Look at some of your staff that may need a development opportunity to bring them to that project, so that then you're helping them to be ready for that next challenge that may come along either next year or a couple of years down the road.
John, this is Tony. Question for you as a CFO. What are some of the things that either a new chief tax officer or one that's about to approach becoming a chief tax officer should be very careful of not doing? We've kind of given you a pretty good outline of what they should do, but what are some of the things that will irk financial leadership that they need to be aware of and not step into those beta traps, shall we say?
I would say don't go down the path of doing, I'll call it a tax project for tax's sake, without having a robust, communication around that project. So to me, in the end, it comes down to communicate, not just with your boss, but with the other departments in finance, because typically you're going to need their support on, many projects, maybe not all of them, but many of them, whether it's treasury, accounting, other parts of finance, or the business units. So make sure you communicate. Don't just do projects for tax's sake, unless you've communicated to make sure that there's organizational buy-in.
This is Josh Mishu. I know you've spoken a good bit about how you get CFO level buy-in for a tax planning type project, but kind of to that last point you were touching on, where you're developing a tax planning project that's going to maybe not align with that sort of perfect business model that you've described previously, and that it may result in additional dollar of operational expense somewhere, but with the benefit of saving $10 of tax liability. How do you get, the non-finance executive who's in operations and who feels that dollar of additional operating expense? How do you get him on board with a tax planning project where he kind of doesn't see the below the line impact of the $10 of tax savings?
Well, and so some of this comes to, and Jim, you'll have some thoughts on this as well. Some of this may come to your incentive program, and I'm a big believer in incentive programs that are driven on cash and cash returns on invested capital. So then, cash taxes end up being part of that equation, and if it's part of that equation, then it's going to be impacting the bonus of that business professional, and he's going to want to make sure that he's minimizing his cash taxes, whether he understands it in the beginning or not. But you educate him that by reducing his cash taxes, then he's going to increase his bonus. Now, if your incentive program doesn't come down to that level, which many will not, then it's going to be helping that business person understand what the overall benefit is to the entire organization. And some of this may be driven by, I'll call it, getting senior management buy-in to then get the other business unit leaders engaged and bought in as well, because senior management will be much more, focused around some of those higher level metrics than some of the, metrics that may be used in some of the business units through the rest of the organization.
Yeah, if I can add to that, if you can achieve that objective, you've somewhat reached, near the top of your profession. If you can influence business guys to truly understand how what they do affects the bottom line, and how if they do it differently, they can have a different impact on the bottom line, and get it to where it's actually very meaningful to them and becomes part of the culture of a company. I mean, I've seen it where, the organization is very, very much focused on earnings before tax. And if you're presenting anything that's more cumbersome to being able to earn those earnings before tax, or actually could have a little bit of a negative impact on earnings before tax, because you're forcing people to be located in a particular country, you're forcing them to operate in a particular manner that's not natural for them, and so they view it in a negative light, et cetera. I've seen it where unless you've got the top management fully bought in and understanding doing it a particular way will save you 10 percentage points on your effective tax rate, which translates into X amount of incremental market cap when you take that 10% effective tax rate differential and multiply it by your multiple of your stock price to earnings, you can have a very, very hard time. And what I would say is it also becomes difficult when you have a lot of shifting of senior management, because you may actually take 6 months and sell someone on the fact that, look, doing it this way makes a lot of sense. You get someone else who comes in that position and you're starting all over again. And so, depending upon how static your senior management is, may depend upon how fulfilled, how successful you are in getting the tone at the top set right to then filter down through the organization. I have seen some very large companies who the notion is completely built into the culture of the company. And the mindset is we have to pay our fair share. We have to, be compliant in our taxes, but we clearly can structure our operations in a manner to reduce our overall effective tax rate. And so it can absolutely work and be very, very successful. I think it takes a lot of effort on behalf of that tax leader to educate senior management, to re-educate senior management, and to re-educate them again. I personally think if you don't talk to someone about a topic 3 times, they don't truly remember and appreciate it. If you're able to do that, I think you can be very successful. There is an elasticity, though, from a business perspective, to always go back to, wait, why am I not doing this the most efficient way possible? And there's always a skepticism that says, well, look, I think I'm losing more from an operational perspective by having to do this unnaturally than you're picking up from a tax perspective. The first response is, it's not my taxes, it's all of our earnings per share. And secondly, $100 of earnings per share sometimes is the equivalent to, EBIT is sometimes the equivalent of, 10 times that amount in revenue. What's your operating margin? And that's what I hear a lot is, look, saving $100 million of tax or $10 million of tax, whatever the multiple is, if I try to translate that into revenues, I can't build that business very quickly. But if you can help me get there from a tax perspective, we've been extremely impactful to the bottom line and thus to our shareholders, the market cap, et cetera. So the point you raise is a great one. It takes a lot of effort and continual discussion in trying to make sure that you have to understand how the CFO and the CEO thinks, because if you're going against the way they think, you're going to fail. If you can help influence how they think, you can be very successful. So hopefully that's helpful.
Yep, that is helpful. Thanks, guys. I appreciate it.
This is John. I have a question.
Sorry, this is Ben Carlson, ConocoPhillips. I have, I guess, something of a follow-up question on those points. So, there will be situations in which you're not effective in convincing senior management that an idea is a good one, either because maybe it doesn't have a bottom line impact because it's just mitigating risk, or maybe you don't yet have the relationships in place. I'm curious if you all ever encountered situations, or Jim, you have where you haven't gone forward with an idea that may be a good one for the company, but because of the political capital that you'd have to spend and the damage you might be doing to relationships along the way, it just isn't worth it. And so you say, well, maybe notwithstanding the fact that this could be a good thing for the company, this is not the time, or let's not pursue this.
I think the consideration of expending political capital on a project or an idea that you just know will not go anywhere, I think that's a very smart career move, quite frankly. Every single circumstance is so different that it's hard, in my opinion, it's hard to make a generalization. If you're talking about, some type of supply chain, modification where, you're basically saying, look, if we move this whole activity from location A to location B, we can shift this profit and have a much lower effective tax rate. Well, I'll be honest, I don't know that. As long as you've clearly communicated it and they've said no, I don't think I'd expend a lot of political capital, even if I could get my effective tax rate down significantly, because they're making a business decision that says, no, we don't want to do that. If it's something that's much, much more mundane, does not have an impact on the business, can drive a significant benefit, I might continue to try to push it in subtle ways, recognizing the fact that I'm not affecting the business. And so it really is something different. Although if it's not affecting the business and they have a problem with it, what's the risk associated with it that they're having a problem with it? So the simple answer to your question is absolutely, I would not expend political capital if you see absolutely no ability to achieve the objective that you're trying to achieve. And if you're going to be in the organization for a long enough period of time, you probably have another opportunity, 12 months later, 24 months later, 36 months later. And so just keep it in your hip pocket and go work on other projects that have more, the company has more appetite for. I think, again, I think I've worked for, I can count the CFOs I've worked for. I need more than one hand. And so what that does say is, look, if you're not getting the appetite or they're not respecting the opportunities that you're bringing to the table, if you go focus on something else and bide your time, you probably get the opportunity to bring them back up at a later point in time with a different audience.
Another way to think about it is sometimes a perfect tax solution can be a perfect nightmare for the business. In other words, it's going to cause the business to have to go through hoops that will just, be impractical for the business to be able to operate effectively. But if you were to come back and think about, okay, maybe there's a compromise that is not the perfect tax solution, but it's going to get me 80% of the benefits with only 20% of the impact on the business. Well, now maybe that is something that you could move forward with the business, where you're looking at much less of an impact. Maybe it's not the perfect tax solution, but something that the business would be able to buy into.
That's helpful perspective. Thank you.
Hey, Jim, John, this is Sam Caulfield. Guys, I've been looking forward to having this call because I was with you guys, of course, for the Weatherford restatements and the material weakness. So this has been a great discussion. Jim, I was wondering, sort of, as you think about how things work at different companies, Weatherford, on the one hand, it could have been, my sort of hindsight look, seems to be almost like an easier experience in the sense that you had that buy-in from the board all the way down to the tax department because of the situation that the company was in. And now, as you've moved on to Nestle, I mean, we've talked about sort of the things that the skills that you need to succeed, whether it's in a crisis situation like Weatherford or at Nestle. But can you get a little more deep into sort of what you've done differently at Nestle, given that it's not a crisis situation?
It's a great question, Sam, and I'll be honest, right? I'm not sure I can change who I am. So I probably operate very similarly to what I've operated like in the past. But to your point, there's a lot more time spent on obtaining buy-in and educating than probably I've ever had to do in the past. And that's okay, because one, I'm learning a new company, right? So anybody who changes jobs, right? You're learning a brand new company. Everyone else has been there 15 years, 20 years, 30 years. They have the history of why everything was done. They have the history of why things are set up the way they're set up. And you come in with a strong tax expertise and experience in the area, but how does that play with the organization? And so, look, we continually evaluate what are the projects we have out there, what are the benefits it can drive for the organization, and build the business case, or quite frankly, the script, the elevator speech as to why the company should be evaluating this and the benefits to the company. And through the different dialogues, whether it's with Treasury, whether it's with legal, whether it's with, the CFO himself, the controller's organization, et cetera, communicate, what it is we're thinking about and why. Being an expert in the tax law, right, and how the tax law changes at the end of last year is affecting the business and why that creates an imperative for us to be thinking about things and doing things differently, right? If you can find a hook, that always helps you, and tax law changes helps you. Look, the 163J regs came out last night, and I don't know about you guys, but 163J affects all of us now. And the DA aspect of those 163J regs, which is if your depreciation and amortization is part of cost of goods sold, then you don't get to add it back, right? And I'm still trying to figure out exactly what that means. That was a complete surprise. I've communicated that already internally, and there were 2 or 3 projects we were thinking of doing coincidentally that 163J was in the back of our minds for, and now it all of a sudden makes it more of a, I won't say a burning platform, but it brings it more front and center. And we even have more of a dialogue as to why to talk about it, bring it up, and try and influence, the outcome that we're looking for. So I think the answer to your question, Sam, is what's the difference between a company where there's a burning platform and you have the stage to do whatever you want, and a company which is much more mature, developed, set in its ways, been successful for 150 years plus, et cetera. I think it's just continual communication, education, in a collaborative way helps to be able to influence in the direction that you're looking to move. I don't know. Is that helpful, Sam?
Yeah, it is. I mean, I think I would agree that it certainly is more difficult in sort of the vast majority of companies which are not in a crisis situation to get buy-in. I mean, just as one example of what we try to do here at Sempra Energy is, we have these tax lunch and learns every month, and we decided that it would be helpful to open it up to the finance team and have them get a free lunch if they would like it, and kind of listen to what we're talking about and what we're trying to educate our own group on, and then get kind of that cross-pollination with the finance team as well. That seems to have worked.
Sam, this
well.
is John. I commend you on that. I think that's a great idea, whether it's a lunch and learn, whether you go into the company cafeteria and see one of your peers in another finance department, sit down with them, talk about the weekend, but then, talk a little bit of shop, find out what's going on in their world, let them know what's going on in your world. Continue to do those kind of things. Some of it can be formal, some of it can be informal, but it's all about communication and making sure that those lines of communication are very open across finance.
So John, I have a question that has been chatted in from Don Marr, who is unfortunately a little under the weather and does have a voice. He asked me if I could ask this, but they've got a question focused on changing the business score cards to be on an after-tax basis. And he wanted to know, how would you recommend, tax go about providing advice to the CFO who has asked Don, and the tax department on how it would work and how they might go about changing those business scorecards. Do you have any, I know you said you felt pretty strongly about how businesses should be measured. Do you have any suggestions on how a company and tax could go about giving advice in that area?
Well, I think it needs to be something that's not driven only by tax, but tax may be the impetus that gets the organization thinking around what I see as cash flow and returns on cash flow value added. There's a number of different metrics or acronyms that can be thrown at it, but where you're looking at what are those not just after tax, but entire cash flow returns that are being generated in the business. Because, you know, when you're focused on cash and cash flow, you're going to have people make better decisions, whether it's in the business unit, whether it's in tax, whether it's in, you know, whatever part of the organization you're looking at. If what they're doing is incrementally improving cash flow or the cash flow returns of the business, then it's going to have a positive impact on earnings. You're going to have, you know, positive impact on liquidity, on all these, you know, great, you know, ratios and metrics that Wall Street will measure the company on, or that, you know, private equity will measure the company on. But I don't think that tax can really be the sole impetus to change the scorecard to an after tax where it's been before tax beforehand. But I think that you need to start to, you know, solicit, you know, maybe it's investor relations, maybe it's, you know, others in the CFO's organization that will understand the benefit of focusing on, you know, something that is, you know, below the line rather than above the line, because I'm a huge believer that a lot of companies, you know, focus at the wrong point from an incentive point of view, and you end up making some, you know, what I call, you know, bad decisions or non-optimal decisions for the company.
Yeah, I think the one thing I will say too is it's a conversation that happens all over the place, and when it comes time for implementation, my experience has been it's a heck of a lot more difficult to do than people anticipate, because when you're trying to incentivize individual business leaders, what is it that they've in fact done to reduce the effective tax rate or influence the effective tax rate? And if they really can't, you don't want them focused on it, because you want to minimize what it is they're being held accountable for to better effectuate or influence the bottom line of the company. What I have seen, and possibly could be a recommendation for the CFO, is, you know, if you keep the bottom line, you know, EPS bogeys to the more senior level executives and maybe the corporate departments who can influence it more, you have a good balance between operations that needs to go make the money and corporate who wants to make sure they keep their eye on the earnings per share. And does that healthy tension, by not giving those metrics to everybody, but giving them to maybe a select group of the organization, does that achieve the objective without overly complicating the metrics? I don't believe here at Nestle we go down to earnings per share. And I know I've heard at least one conversation about it. And what I've heard is it's very important. And trust me, the CFOs care about the bottom line, but at the same time, they care about clarity and metrics and the objectives that they're holding everyone accountable for. And the more you complicate it, it just gets a lot harder to effectively manage it. And so maybe that's just, you know, a point to throw out there. I think
that's well put, Jim. If people can't understand how their actions can impact their bonus, then the bonus plan is not going to be very effective. So you do absolutely have to keep it simple.
If anybody else has any other comments on that, we don't have to belabor this one, but you can chat those into me, and I can certainly bring those up to the group later, or we can pass that on to Dawn.
So we've got 7, 8, and 9, which all deals with strategic and operational leadership. And I do like the way it's framed up, which is, you know, strategic leadership is how you're going to frame up the issue and you know, how you're going to be thinking about the future. Operational leadership is how you will execute. And, you know, the more you've been ahead of tax, the more you actually think about it, right? And you think about, how does your actions affect your people? How does your actions make them more energized to do their jobs to a higher degree? How does your actions actually take away from their motivation? You know, and the one thing I will say is, I do think everyone's personality is a little different. And so there is not one right answer that will work for every person all of the time. I do think it also depends upon, your leadership style depends upon the type of people you have working for you. If they're self-motivating, high energy go-getters, you probably just let them be, and they're going to achieve the results that are needed, and what you're doing is helping influence them along the way. If they're not high energy, maybe it takes a little bit more direction and control, to ensure that they're achieving the objectives that need to be achieved, and they're doing it timely. But the one thing I would say as a leader, which is really, really important, is appreciating that your actions and the way, your actions will influence very significantly the people that report to you, and it could be a positive way or a negative way. And you really need to learn, everyone's preferences and their styles, and try and adapt appropriately to get the best out of everyone. I know we don't have that many minutes left. So, John, any comments on strategic leadership from that perspective?
Some of it gets back to, how you're going to prioritize and, prioritize within the business when you're talking about strategic and operational leadership. And that will change within an organization over time. And clearly different organizations will have different priorities. And so, we were talking about Weatherford before, where, there were a lot of, issues when you came in. Some of them were known, or many of them were known, and, they were, big and hairy and really needed a lot of effort. But another organization, as you were saying, is more mature, and you just have to function a little bit differently. And so just understanding, what that strategic focus is of the organization, but that may change the next year. In other words, you may get into an M&A mode in a year, and now your tax focus needs to be in a different, area than it was, a year or two before. So, I think that strategic and operational focus is key to make sure that you sort of understand, what the priorities of the organization are, but just also remember that, that can change over time.
All right, and I just realized that we probably have until 2:15, so we probably have a few more minutes than I was aware. But if we go to some of the questions, because those are good points John made. One of the questions was, the only constant is change. Or I love the point about the only constant is change, and I could not agree more. If part of a long-established group, if part of a long-established group that are set in their way and struggle with change, what is the best approach? How do you show them that certain change is good for them in the company and the shareholders, even if it is tough? And then there's the second question, which is, in setting up and taking over a department or getting hired to a top spot for the first time, what advice do you have for a VP about how they would go about moving tax in a direction that is different from their predecessor? Do you have any advice about how to get the cross-functional teams on board with a change in direction? What I would say is I have taken over a department which is set in its ways, right? Nestle's the reason I got hired at Nestle, just to be transparent, was there was a perception of the U.S. leadership team that the tax department was separate from the rest of the organization, and that maybe it wasn't being as progressive and changing and redefining themselves as they needed to, as industry starts, as the market in the industry was getting more difficult from a consumer products perspective. So, look, nobody wants to pay more for their DiGiorno pizza today than they paid yesterday, yet, energy prices are up, cost of materials are up, et cetera. And so, we as a company, we're the largest food and beverage company in the world. We still have to reinvent ourselves every day, find ways to do what we did yesterday more effectively, because, we're getting more and more pressure from our customers, which are big retail, and consumers to give them higher value for a lower cost. And so there was a perception that, hey, tax, while it was extremely effective, and the tax department here is very good and very effective, it wasn't being progressive in bringing change to the organization that could be required, or quite frankly, just doing our jobs more efficiently and thus being able to do it at a lower cost. And I mean, look, the way I've approached it is, one, trying to understand what the current state was, trying to understand the folks that were here and what their strengths were and potentially their areas of improvement, trying to understand what the department did really well before, and then trying to understand, maybe what wasn't done so well that we could do differently, and then getting buy-in from everyone as to a future vision. And I think getting the buy-in as to the future direction is absolutely critical. And at this point, we have that buy-in from all of the CFOs in the market, as well as we have it from the tax organization itself. And so we've actually got a tax transformation project ongoing, which is looking at every single tax area, mapping out how we do it today. And we've got different businesses, and some of them do it differently. So we're looking at how we do each area across each business. We're then layering them on top of each other to say, what is the one uniform approach that we will have? We're getting buy-in from all of the tax, professionals in that area. And then we're going to modify the processes, quite frankly, to better use technology and streamline where appropriate. And then, quite frankly, we're going to implement the change. And we're doing that across 15 different areas. And the energy level within the department actually is exceptionally high. And the reason is, what they said was, we always had these great ideas before. We always wanted to do things differently before. We were never allowed to do things differently because the prior leadership just wanted to have silos and have everyone operate, the same as the past. Now, to some extent, you can discount a little bit of what you hear and say, look, there's always two sides to everything, so appreciate that. But it's very clear from the CFO perspective and the department perspective that there's a high level of energy to allow them to be, quote unquote, free to design new processes that are more effective and efficient for the organization. And so, it's interesting because if the mentality was going to be, we're completely set in our ways and we don't want to do things differently, and so trying to have change would be problematic. It's not what I've experienced. And I think maybe the key is really just focusing on trying to understand the culture, the people, and see if you can somehow energize them, energize them. The first month I was here, I went to 5 different locations and had meetings with everybody, told them about my background, the fact that, I wasn't here to completely change what they were doing every day, but was here to help them identify what the changes could be, and then implement them as appropriate. And it was received very positively. Now, I personally take, when things are going well, that's great, but I always worry about, if today's a good day, tomorrow's going to be a bad day. So, be prepared for it. So far, I think giving people the opportunity to be part of the change and lead the change has worked out well, and there hasn't been as much resistance as I probably would have thought there was. And as far as each area, right, these 15 different areas, it's everything from records management to sales and use to property tax we have bottle tax and sugar taxes because of our beverage businesses, obviously income tax, et cetera. And we have leaders from the organization who are taking accountability for each of these areas or responsibility. And it's actually working out exceptionally well. And the reality is when you let your people kind of prove themselves or demonstrate what they're capable of, it's amazing what they can achieve. Now, at the same time, if you determine that you don't have the right leaders and right positions, it's incumbent upon taking steps to try and fix that. It could be trying to rehabilitate someone and giving them different opportunities once you've communicated, once you've communicated to them, that potentially there needs to be a change. But, bringing new people in potentially is important. I think the other thing you really have to do is be sensitive to, if you have strong people in the department, that you continue to allow them to demonstrate and have key positions and feel empowered, because clearly, especially with a large organization, if you don't keep your key people or the individuals with a lot of the history and the talent, you're going to end up, or history and the knowledge, you're going to end up with a big problem. Because as everyone knows, for tax, part of what's important is your technical skills. Part of what's important is your knowledge of the company and where all the information is.
Hey, Jim,
Okay.
I had a question get chatted in. I'd like to get yours and John's perspective on this from Derek Cyprian. He said, how would you handle coming into a department in the top position where one of the top or more valuable employees was considered for the top job and didn't get it? Do you have any thoughts or strategies on how to keep that person on the team?
Yeah, I mean, I think what I would say is, so I came into that exact position. I have a very, very strong leader in one of the areas who was hoping to receive to get the position, and because management had decided, look, we were looking for change, and we don't think we're going to have change if we have an internal person, they went outside. And the way I've engaged with this individual, quite frankly, is still giving a significant amount of autonomy, as well as trying to demonstrate the vision in the direction that we're going in, as well as keeping this individual, fully, on the team. And I've had several conversations, and the feedback I get is, I wasn't sure where you were heading in that direction, but having observed, I understand now. And I've heard that more and more. And my message to this individual is, look, I haven't been anywhere for more than 6 years. Maybe I'll be here for more than 6 years, but if I'm not, my goal, quite frankly, is to allow you to be if you want it, because look, it all depends upon what people want. My goal is to make it absolutely certain that you are my heir apparent, no questions asked. And so, if that's what interests you, I'm completely happy with us ensuring that's the case. And by the way, these are the 3 reasons why you didn't get the position. Let's work on those 3 reasons. So, I think sometimes companies do things not because the person is not capable, but there's a whole lot of other factors that come into play in trying to communicate why those factors came into play, trying to then help address them, can keep that person happy. And the other thing too is, look, if the CFO is the one who made the decision, make the CFO talk to this person. Make HR talk to this person. Put together a plan to say, look, we won't let this happen again. You're the next heir apparent, and we will have done the following 5 things to make that the case, to work out or address any of the issues that caused you not to get the position. So,
Jim, I think you've hit on some real key points there around helping this person understand why they didn't get the role, and then, maybe even, restructuring their responsibilities so that now they've got, responsibility over some areas where they were viewed as not being, not having the necessary requirements or whatever, or where, the view may have been that, this person, wasn't, they were part of the old organization, so how are they going to affect the kind of change that's wanted? Well, get them as being one of the leaders of change so that now, they're seeing, what change looks like, and they're very involved in that. But then the other side of it is, maybe the negative side where you have someone who just doesn't get on board and is, putting a stick in the spokes or throwing a hand grenade under the tent or whatever it may be. And if that's the case, and, you've done all the things that you should have done, to get that person engaged and they're not engaging, then it's time, for them to move on, because it's not good for them and their career. It's not good for the organization. And, I've always, or I've never felt like I let someone go too soon. When I reflected, I've always felt like I gave someone too many chances when I reflected, and they never got on board. So I absolutely, will, bend over backwards, to help someone further their career. But if they're not going to get on board with the culture and the direction, then it's time to part ways.
well, and then to add to John's point, right, transparency is absolutely critical. I think as you go through different stages in your career, and everyone's a little different just inherently, what I've found is absolute transparency is probably best than maybe beating around the bush or not, not addressing an issue head on. In the end, I think everybody appreciates it much more, and you get to the right answer much quicker. So, I mean, I've had conversations with people here that says, exactly what do you want? Let's walk through what you want. What are your strengths? What are your weaknesses? Where do you want to be in 5 years? Are we going to be able to help you get there or not? Here's what the perceived issues are that have to be worked on. And look, wherever that conversation goes, it goes. Most of the time, it moves in a very positive direction. And most of the time, you and the other person is much better off for it. And I think that comes. Some people are just much better at it than others, and I think the effectiveness and appropriateness of that approach is more apparent the longer that you've been in a lead role. Or at least if someone had told me that early in my career, I would have benefited from that immensely. So the other way to deal with situations that you come into is just be absolutely transparent and, say it the way it is, and just be polite in having a conversation to figure out the right path forward.
Yeah, this is Tony. So for better or worse, the position I'm in, I see literally hundreds of these situations. So the experience is really based upon a couple of factors I tell everybody. Number one, do you really believe this person was a viable number one candidate? You, the management team, John, the CFO. Were they just in there for show, or were they really a serious candidate? A lot of people ask us to interview candidates that they would never put in the number one role, but they felt obligated. They needed to at least let them feel like they went through the process. So Derek, you need to find from management whether your number two is ever somebody they're going to support, no matter what you do in development, to be the number one. If in fact they're not, then you need to find out from this number two person whether they truly wanted to be a number one, or they only put their hat in the ring because they didn't want to deal with the new head of tax and go through all those adjustments. I cannot tell you how many number two people really don't want to be number ones, but put their hat in the ring because they're fearful of who the number one might be.
So you really have a couple of data fact gathering processes you need to go through. Upper management, is this person ever somebody they seriously considered, really? Number two, the candidate themselves, did they really want to be a number one? Why did they stay in a number two role so long if they truly wanted to be a number one? They got to be able to answer those questions. Now, you could come out of a situation where they don't really want to be a number one, and you just need to give them some room, like Jim talked about, make them feel valuable. Maybe they just want to be that number two, and they believe that might be the best job in a corporate tax department. You guys have heard me say this before. The lead number two jobs might be the best jobs in corporate tax. You'll figure that out when you get the number one job, right, Jim? It can be more than you asked for, okay? The next thing is, let's say they do want to be a number one and they're not going to be it there. You don't have the likelihood that you're going to leave in a near term and create room for them. You can keep them for a few years by developing them, and as Jim pointed out, figuring out where their gaps are. What do they need to fill in? If they can't be a number one there, they can be a number one somewhere else. You can help them get there. The trade-off for that is you keep that legacy knowledge with you for a couple of years. It's a win-win every which way. The only time this gets blown up, and it can blow up, is when you get somebody's anti-management. They hold it against you. They're a cancer in the company. And I tell everybody, get them out of there as soon as you can, legacy knowledge or not. Those are my three scenarios. I map everybody the same way. When I did the recruitment for Nestle's for Jim, I sat down with the CFO, who's now the CEO, and had those exact conversations with them about the internal people, asking tough questions and making sure we got those answers up front so there is transparency, and then paint the picture for the candidates realistically that way. That's your best bet, in my opinion.
So the last slide that we have, just being sensitive to, we got 1 minute left, is dealing with the budgeting, because I think we've addressed strategic and operational leadership a bit. When it comes to budgeting, it is a complete art form that you really need to learn. You need to be transparent with your CFO about what you're doing and how you're doing it. But having been at 3 different companies with 3 different budgeting styles and multiple CFOs who view things differently, I mean, in the end, companies are, they have to provide an estimate to Wall Street, or most do. They have to then meet their estimate, and unfortunately, our expenses, even though they go and reduce the tax expense, right? They go against your operating budget that goes against earnings before tax, and being able to manage your budget, meet your budget, but also meet your objectives by having an appropriate amount of resources available is just critical. So we could spend an hour on all of the kind of nuances that go into the budgeting process. I would strongly recommend you learn it early and very quickly, and that you just stay very, very proactive, because you only get in trouble. You will get in trouble when you go over your budget if it's not communicated early, and if the CFO doesn't have visibility to what you're spending your money on. And the more value-added projects you can present and deliver, it does help significantly with the budgeting process, because even though it's affecting operating results and not, you don't get credit below the line in taxes, the CFO will do the mental gymnastics to say, well, yeah, you may have gone over your budget a little bit, but look at what we've achieved. I'll have that discussion with the board and the CEO. And look, being able to project right now, during the 2018 budgeting season for 2019, being able to sell the projects that you're going to do next year and what the cost may be, and building that into your budget is very, very critical. And I know for a fact that my budget's gone up significantly for next year, because I've listed out, here are the projects we want to do, and here's how much it's going to cost. And in the end, will we do them all? Maybe not, but at least there's a placeholder in the CFO scorecard for my budget for being able to do some of these things. But it's being very proactive in presenting early. So I'm presenting, I've been presenting for 3 months. Here's what we should be doing in 19. We built it into the budget. Now let's see if we can get the resources and get it done. But if I didn't present it in 18 and I tried to bring them up in 19, I wouldn't be doing those projects till 20. So that's, I guess, some comments here from a budgeting perspective. I don't know, John, if that resonates with you or not, or.
Well, it does, and there's a couple of thoughts or points I'd like to make. One, don't sandbag, but absolutely do underpromise and overdeliver. And I just can't emphasize that more. And let me say, well, wait a minute, you're saying the same thing but opposite ways. No, sandbagging is one thing, but underpromising and over-delivering is something else. And you need to get to the point where you can understand the difference between those two, because underpromising and over-delivering will help make you very successful, and sandbagging will, get you put into a penalty box. The other thing, and it's on the fourth bullet here that I really just want to emphasize. So if you are told no, that may not necessarily mean no. It may mean that you have not communicated effectively. And sometimes you just have to step back when you have a good project or with your budget and you're just told no, you can't have that increase in your budget, and you think that it's absolutely justified, that these are good projects that are worthwhile. You just may not have communicated the importance of those projects effectively, or maybe in, I'll call it a timely manner, going back to Jim's comments around, he's been socializing some of his projects he wants to do in 19 for several months, so that when he gets into the budget discussion and he's talking about something, that's not the first time that someone's hearing about it. So he's more likely to get a yes when he's been socializing it several times, rather than something he brings up for the first time in the budget review. So think about why you got the no, and then come back, and maybe it's you need to lay some groundwork. Maybe you need to take some of the technical language out of the project that you're trying to explain, because you're not speaking to someone who is tax technical. But if you've got a great project, or if your budget is being reduced and you think that you've got some benefit to add, think about, okay, why did I get that result that I don't think was the correct result? You've got to be positive about how you approach this. Don't be negative, but think about, is there a better way that I could communicate what I'm trying to sell?
Also be sensitive to your audience in when you're presenting something. I have gone into meetings and pulled back on presenting something because I realized the audience was not in a very receptive mood at that time. And so unfortunately, sometimes when they say no, they remember the no matter, even if it's the best thing, even if it's the right thing to do. And so also be sensitive to when you're presenting it. And if you go into the room and the CFO is in a really bad mood because you just got out of a meeting with the CEO and he got belittled for X, Y, and Z reasons, just find a politically nice way to exit the meeting and reschedule for a week later. Because sometimes, a no is a no, and you could have been much better off just by kind of delaying your discussion.
Well, I know we're running just a few minutes over, but I did want to go ahead and open it up for questions. I know Jim and John will hang on for a few more minutes here if anybody else has any other questions on budgeting or any other topics that you want to go over. I haven't had any chatted in, so I'm going to assume that everything is good. Jim, John, I can't thank you enough. This has been outstanding. I think this is really, really relevant data for both of you guys. I really appreciate you guys giving me the time. I did misspeak at the very beginning of the presentation. Actually, right before Jim joined, I said we were going to have our next session in March. That is not correct. We're going to have our next session towards the end of February. We did not want to wait all the way till March. So we are going to have a next session at the end of February. In the meantime, between now and then, we'll email you guys a copy of this recording for you to go back and listen to. If you have any other questions, you can post those on the forum. We'll make sure we get those questions over to Jim and John and get responses to you. Also, don't forget that, as Tony mentioned, we will be putting out that article on demographics. We'll make sure that the Symposium members get a first look at that before we release it to the public. And like we did before, we will set up a time during the end of our next Symposia session to go over any questions you have on the article and things like that. So if you guys have any questions for us while we have the little bit of break here for the holidays, don't hesitate to shoot me an email. I know you guys have my email address, and we look forward to talking to you guys after the holidays in the new year. Thanks, everyone.
Thanks, John. Thank you, Jim. Appreciate it. Take care, everybody.
Thank you to everyone.
Thank you, everyone.
Thank you.